Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about all the influences on mortgage rates and how that's playing out right now, including Friday's jobs report, comments from Federal Reserve presidents, even the dispute between President Trump and Elon Musk. Logan, welcome back to the podcast. Here we are on Jobs Friday. We are recording this on Friday, June 6th. And boy, oh boy. Okay, tell us what your takeaway was from this jobs report.
You know, the labor market is finally underperforming my estimates after today's report. Today's jobs report had a little bit of everything for anyone. But after the negative revisions of 95,000, the year-to-date monthly job creation is now at 124,000. So I went into the year, and for people that followed my work in the last decade, this is very similar to my job. As the expansion goes, because population growth is slowing down, the labor force is actually shrinking to a degree. I always tend to lower my job estimates, not raise them. So I went into the year at 133 to 151,000. That would be the average. After today's report, even though the headline beat estimates today, if you put them all together, we're slightly under now at 124,000 per month. Now, the unemployment rate, like 0.06%, would have been lifted up to 4.3%, not 4.2, how they calculate it. So it's going to get a little bit more tricky for the Federal Reserve going in the second half of 2025 if this continues. If there is there's a rebound effect because of what was happening initially because of Godzilla tariffs and, you know, a lack of transportation or stuff going on in that regard. Okay, maybe you could perk up a little bit, but as the trend is going, it's underperforming. And last year, I was below a lot of people's job estimates. I was 140 to 165,000 per month. But the jobs data was always outperforming my estimates until the negative revisions finally kicked in. And to me, it looked right. To me, it looked about normal to where. But for the Federal Reserve, who touted, well, everything's strong. Oh boy, we got to cut 50 basis points. Okay, we got to cut. This becomes a little bit more tricky going out for the Federal Reserve. And I say this because 20 minutes before the 20 minutes before the jobs data came out, the president of the Cleveland Fed, and Sarah, you and I wrote, we wrote and talked about this last month, that the Federal Reserve presidents might be going to phone calls more than the data. And Hammack, basically, the Fed president, said, I'm talking to a lot of businesses, and they're kind of like, there's a lot of angst about tariffs and everything, but they're not planning to lay off people. So I remember, they're going to wait. Remember that premise,
right?
She literally said this. I'm going to wait until we see that it hit the data, and then we'll play catch up. New York Times, we'll play catch up to it, but we'll wait, which implies that they would have probably been a little bit more open at this stage. Headline PCE at 2.1%, but they're going to wait to play catch up. Catch up basically means we're going to be too late. That's
Also, she said in that interview with the New York Times, I legitimately do not know which way this is going to break. So you see a trend, and it doesn't seem like she sees that trend. What do you think about that?
The irony with Hammack is that Procter & Gamble's headquarters, I think, is in her district, and they just laid off 7,000 people
yesterday.
So, for me, it was easy to basically say, okay, listen, we're at 140 to 165,000. It really depends on what people think the labor market should be, but that looks right to me. So that's not breaking. But here, because of my own thinking, we're underperforming now, and they're telling us they don't know. I'm never in the camp that I want to wait for something to happen. I always want to be cautious on the other side. Then the counter to me would be, well, the Federal Reserve's models tell them if there's a shortage or tariffs or anything like that, you don't cut rates into that environment because it can keep that inflationary pressure going. That's how the Federal Reserve looks at that. That if, and then we're like, okay, well, during COVID, there was shortages and zero interest rate policy, so it gets a little bit more tricky. Of course, President Trump, right after the jobs report, even though it beat estimates, 1% rate cut, the Fed's too late, so he's doing his thing. By the way, the Trump Musk thing, that was interesting.
Wow, that was crazy.
So I just think now it gets a little bit more difficult. It's one thing if jobs were running at 160,000 per month, beating estimates, or how I looked at it, I would sit here and go, hey, it's beating estimates, or but here I can no longer say that after the negative revisions.
So to your point, this report comes out in a very charged environment for the Fed. Now, if they were going to cut rates, they wouldn't cut it by 1% anyway, right? I mean,
no, a 1% rate cut something has to happen, right? You'd have to, like, a 0.5% rate cut. The Fed, like they talked about, they were behind their own model, so they just anticipated that the labor data was that strong and the revisions knocked them out. So you're looking at 25 basis rate cuts at a time, or let's just say hypothetical. Let's just say the next 3 jobs reports were averaging 37,000 per month, and the negative revisions, that is something that could warrant a 0.5 basis point rate cut, or something like that was occurring, and then we had some type of other economic shock that occurred. That's when you do, stuff big like that. Or you do you don't even wait for the Fed meeting to happen. They just cut in between meetings. We're not there yet or anything. But just based on my work, labor data is now underperforming. But if we're talking about what Hammock said, I'm going to wait and play catch up. That means she needs to see more weakness. Then when she sees a weakness, then they feel like they can cut, and then maybe you could get more aggressive with the rate cuts at that point. But again, catch up implies late. New York Times article, people. I go out there and read it. The whole premise was they would wait as much as they can, as long as they can, as restrictive as possible, but they need cover. They feel like they need cover to do this. And they're literally saying this in the national media. We will be catch up.
So a couple of points within the report itself. Let's talk about construction workers, because this was something.
Yeah, and this is before, we talked about this in the last podcast. Before this jobs report, 2 of the 4 residential construction jobs reports were negative. So if this came negative, it would be 3 out of the 5 and back to back. Okay, that, for me, that's like, okay, that's material. Here, not only did we show growth, but the previous month was revised higher. So now we only have 1 negative report for the year and just very slow growth being created, but it is growth. And for all of you that have seen that chart, here we go. We show it. This tends to break, right? It's not so much manufacturing. Manufacturing jobs were lost in this report. We had manufacturing jobs were negative last year. We had a manufacturing recession in 2015 and 16, but that doesn't necessarily mean the U.S. in itself goes into a recession. So in this context, it'll be interesting to see going out for the rest of the year with the residential workers. Do we just have a very, very slow growth, or are we going to have another negative report? We just have a kind of this back and forth out there. But in previous recessions, this data line, no equivocation, heads lower out there. So interesting jobs Friday in that sense. There's a little bit for everything. A lot of people said, look, the negative revisions, we're going to do this again. By the time the Fed realize it, they're going to say they're too late, or others will say, look, there's no clear labor market breaking and the Fed doesn't want to cut into the tariff situation because we don't know what the tariff situation is going to be. We don't have, in a sense, kind of deals yet out there. So it's one of those things. It depends on how you want to, put your foundation. Do you want to get ahead of the curve, or do you want to just, hey, listen, we'll just take our chances and we'll wait, or we'll play catch up. That's a term, catch up. We'll if the data starts breaking, we'll catch up to it.
So the other point that we saw in this one was I think we finally saw some federal job loss that showed up on this report.
Well, the government, the total government report was negative. Now, the federal workers are one things, but so much of the hirings in government work are state and local. But eventually, for the first time in a while, state government, I mean, just the government reporting in this report was negative. Where last year, a lot of people said, well, 1/3 of all the jobs created is government. That's way too much. Now, federal workers, as you can see in the chart, has been falling since the start of the year. If there's less money in the system, right, especially given to states, they don't have the budgets to hire people. And then in some cases, they have to fire people. So if you're losing on the state and federal side, that's no longer going to be a growth engine for you in these monthly reports. Here, it was actually negative for the first time. I think everyone was anticipating this to eventually occur, but going out in the future, if there's less money given to states, then there's going to be less hiring for state workers. Or if they're withdrawing programs that come into the private sector for states from government grants or money like that, then that's less money moving around in the system.
So have we see is there what part of this report would show like dock workers or truck drivers? Because we heard that should be some impact of that. But are we seeing that anywhere in the data?
Transportation warehouse, which is,
Okay.
when we talk about trucking and everything, you got to remember, we literally, man, the ports basically stopped.
Right.
There's no ships coming in. So this is like COVID, where there's no need for that. Now, do you lay those people off knowing that the ships are starting to come? So it's not so easy in this matriculation out here with the data. And again, the tariffs are not fully impacted yet. Like, we put Godzilla tariffs, we don't do anything about them. No deals are done. So the data doesn't flow as fast, but it is interesting that this is the first time that I could say this in a while. The labor data is underperforming my estimates, and that has been a while for me to say that.
Yeah, the honey badger labor market, no matter what's happening in housing and other things, it has just been barreling forward.
Yeah, it is interesting how people should look at this, because for me, it's always been that the Fed needs labor to actually break to get here, versus the labor market slowing down, right? And the hirings, hospitality, is very big, so it's, I know it's confusing. I was talking to one of my oil trader friends, and he's like, "Man, you're in an industry that is like very high unemployment and needs lower rates. And how do you like tell people like the labor market is still stable?" And I was like, I literally feel like Jon Snow in Game of Thrones, where they're coming at him. I'm just taken out. And for like years, I've had to say, listen, the labor market isn't breaking. The labor market isn't breaking. And everybody keeps on telling me, well, the household surveys are this and that. Nobody cares. I'm telling you, nobody looks at that stuff. If the labor market was literally breaking, jobless claims would rise, job growth would really slow down, the GDP portion of consumption would fade.
Hmm.
And that hasn't occurred. And the Federal Reserve has literally said that we focus on the growth of consumption in the quarterly GDP is in our way we track it, and it's still holding up. It's not how I would approach things, but it's how they would approach things. And we're sitting here in June 2025, and it's just a case. And again, the Fed still believes they are modestly restrictive. So some people go, well, really, if they're restrictive, why the stock market is at highs and we're not losing jobs? Moderately restrictive and neutral policy are different. So they're not at neutral yet. None of our conversations have ever talked about an accommodative stance.
Right.
That we have not brought that question up or even talking point. That would be a whole different conversation altogether. But we're not even there yet. We're just finding a way to go down to neutral. And when President Trump says 1% rate cuts, 1% rate cuts gets to that 3.5 level where I say that would be neutral for the Fed. Right. So people can make an argument. Maybe does the Fed really need to be modestly restrictive in this environment? And the Fed would say, we don't know what's going to happen with the tariffs. We don't want to cut rates and then have tariffs in and then have that inflation stay sticky. It is what it is. We're just here, but you can see what's happened this week. The 10-year yield went lower after the ADP report. ADP report was a big miss. And then we basically kind of went back to the ADP level and or where the 10-year yield after jobs wasn't breaking. But if you look at the internals of the report, especially permanent jobs being lost, there's all these things in there now, but now the job growth is now, I could say this is below my estimate. So everybody has their own numbers. Some people would say as long as you're creating over 70 or 80,000 jobs per month, you can still keep the unemployment rate low. So unemployment rate is now 4.24%, 4.3. Not a lot of wiggle room left for the Fed, right? With slowing growth. So we'll see how this works out in the second half of the year. But it's been a while. It's literally been a while since I said the labor market is underperforming my expectations. And when I do these things at the start of the year, again, none of us had Godzilla tariffs in part of the equations, right? Or we're going to do 90 deals in 90 days or stuff like this. Okay. So we injected two different shocks, withdrawing money from the system, firing federal workers, and then Godzilla tariffs. It's a little bit now shaky on that side going out. So we'll keep an eye on this. There were some positives in the report, some negatives, but now the trend is slowing with the revisions now, and it's slowing below my estimate. So I'm just staying true to what I said before the year started, just like I was last year, where like, okay, we're back to where I thought we should be.
I appreciate that so much. So, you've made the point that so much of where mortgage rates are depends on Fed policy. Did you say 65 to 75%?
65 to 75% of where the 10-year yield can range within a cycle is still Fed policy, right? If you go back to the 1970s, all the way to 2025, where the Fed funds rate is, where the 10-year yield is, there's ranges out here. And then everything else is economic data. What happens, like last year was a really good example. The bond market was really authentically saying that the labor market was breaking. They pushed the 10-year yield lower, they pushed the 2-year yield. And all of a sudden, when the labor market stopped getting weaker, and some of the economic data was beating, then bond. And here's another case, the City Surprise Index, which was starting to get positive again, is now starting to slow down. So there's other variables into this, but Fed policy really kind of runs the show on where bond yields could be. And then it starts to make sense because I always refer back to the 1990s when the debt was lower, the deficits were lower, the debt to GDP was lower, but the 10-year yield and the 30-year yield was so much higher back then for that decade. And people were like, oh, the deficits are low, but hell, we're talking about 6, 7, 8%, 10 years, a 30-year yield at 9% to start the decade. So Fed policy really runs the show. So I think if people say Trump doesn't understand that the Fed funds rate doesn't control mortgage rates, that's not necessarily true. All it does is it can lower the bandwidth of where the 10-year yield can go. That's why, and I always refer back to when President Neil Kashkari of the Minneapolis Fed, he basically said, listen, if we wanted mortgage rates to go lower, we can. We could just cut rates and rates will go lower. We can do that. We don't want to do it. Okay.
Which is why Trump keeps going, no, you should do that, because he knows.
Yeah. So I think a lot of people will give Trump grief, but if you look at the history, there's some validity there. It's just not going to be like instant, right? Because the bond market could get ahead or below. I would argue that the 10-year yield never got as high as it possibly could have in this cycle when the Fed funds rate was at peak in 2023. When you start getting above 5% or 6%, we had a downtrend from 1981 going down. If you took the 70s out of the equation, really like 5-6% level would be like historically the high end level for like 8-9 decades. But we had the 70s, we had stagflation, inflation growth rate was falling, so Fed raised rates on there. So, but if you take that period out of the equation, this is kind of where we are. And if you look at inflation since 1910, the average is like 3.1, 3.3% around there. It's CPI headline. So we're actually below headline CPI is below the like 100th century average right now.
Okay, well, so we're talking about one part of the biggest part that can influence mortgage rates. But yesterday, so we're speaking on Friday. So on Thursday, you wrote an article that I really appreciated because we had the big fight between Trump and Musk. And your first thought was like, okay, how does this, because this is not a typically normal sort of White House relationship, right? I mean, normally, something happens in the White House. Oh, we're not going to write a thing about mortgage rates. But because of Musk's very specific role in this administration, it's like, hey, there are some factors here. And so you outlined three factors that could affect mortgage rates. So we have no idea where this dispute is going. By the time this comes out, they could be best buddies again. But I think it's worth mentioning the three factors you said that how Musk or this dispute could affect mortgage rates.
So I think with the interesting aspect Musk said is that he basically told Trump, listen, you have Congress because of me. So when I think about mortgage rates and what can happen, what do we know already? We know that the Federal Reserve has said if there was no tariffs, we'd have a different mindset. If there starts to be deals, we'll have a different mindset. So what is one thing? Congress has the power to take the tariffs away.
Right.
As this goes on, it's just hypothetical. Let's say Musk and Trump don't kiss and make up. I think they have to, just because I don't think the president can have him do his constant thing, and he has way too much money. But let's just say, and a lot of this is because he didn't get his tax credits. But I mean, honestly, Musk is not like really, he doesn't really care about the federal debt. Nobody really cares about the federal debt, to be honest with you, in Congress, because you would need like bond markets to just blow up on you before you do anything. But in any case, let's just say he starts gathering Republicans who don't want the tariffs. Then he starts putting money into Democrats in very close elections, and they lose enough House seats and Senate seats to where they'll take back the tariffs.
Mm.
That's where I think mortgage rates, if that story became something, which we're so far from ever having this conversation, that could be something where the parties go, listen, as soon as we're in, we're taking this tariffs away. That's assuming that the trade war did not go as planned. There's no deals and things are getting worse. That's the, I mean, I hate political economic theory, but if I had to model something out, it would be something like that. Out there, there are people that says he could kill the tax bill. I don't think he could kill the tax bill out there. But if you cut taxes, there's going to be more bond supply. Listen, we've had deficits during COVID, and what were rates doing?
Right.
We had major deficits during COVID. We're spending money like we 3% mortgage rates, Fed funds rate at 0. So if we were talking about mortgage rates, I have to incorporate what the Fed would do. And then if it became apparent that the tariffs were going to be rescinded, then maybe Fed presidents would go, okay, we could start talking dovish again. That's the only thing I can make up out of that to me has any kind of validity. But who knows? They'll probably kiss and make up and we'll be, friends again. I can't wait till I have one of the doomers that'll take me on X like that, because, for those that don't know, I one of the things I do on social media is I challenge people to live debates, because you have a lot of people who talk trash, but they don't show their names and faces. And none of these people actually forecast and model stuff. So I thought in 2022, if I could get these people to show their names and faces and their forecasts and models, you all realize these are just doomer grifters out there. Right. So whenever that happens, 99.9% of the people just walk, right? Because, that's what it is. But I was imagining, what if I had like a doomer person? Like he was a Russian troll, but he was an American citizen that's a Russian troll, and we just went at it all the time. That would be fun, but
you would love that. This is what
I would love that. I would go, let's go debate right now. Let's get your forecasts and models. Let's read them in the last 3 years. And we're going to do this every single year for the next 10 years. I don't think you could do this. That's how I would approach it. But nobody wants to play. I keep on challenging people, and it's, what's the funniest is the, who the loser type of guys are, is that when you challenge them to a live debate and then they actually, they don't accept, because I give them 30 minutes. If they don't give them 30 minutes, we block them. Soft, right? Then they go, oh my God, he's blocked me. He won't let me fight him. It's like, I gave you a chance. And man, this is America. We play ball here. If you're talking and you're hiding your name, no, that's just soft. That's why I love to do it, because once you get guys to actually write their adult names down and show their face, oh my God, the whole thing changes. Right? They can't do it. That's my experience. And the people that have debated me, what I've seen is that they don't really actually have models or forecasting.
Right.
You could just see this by the way they talk, which is really interesting. If you could go back and watch my YouTube debates on people, you could see my face going, that's not right. And you're now off by 37% on your price crash calls. So, but
I do think they
that's how
don't
we do it. See,
realize.
because this way I can teach people, right?
Right.
Teachers have to find ways to connect to their students, right? And unfortunately, this is a social media world where it's crazy. But it's the gladiator theory, right? If you get people into a ring, then the people will come and watch because they want to see a brawl. So if I could get people to debate me, and then they have to write their adult names down and forecast, they can't do it. So most of them run. But imagine if I had one person that constantly battled and showed their forecasts and models, but yet to this day, not one man for the last few years has ever done that. Zero, whopping zero. Nobody's ever done that forecast and model work.
It's true. I mean, you have had debates with people, and what I will say is that you are very respectful, but you let the data take them down.
Oh, I
You're
just
not
need
like,
them to talk because they
yeah,
clearly don't show their forecasts. I still to this day can't believe people have accepted actually think it's all a bait trap actually. I see the thing is I kept everyone's forecast, like literally I have
right.
everyone's name and face and forecast for the last, oh my God, there's going to be a day of reckoning because we're going to elongate the calls and how long and how off they are. I am showing mercy because for some of these people, this is how they make money and their livelihood, but I am showing mercy by not doing it now. I've showed that the totality of the calls since 2012, just the general theory, but I've got everyone's name and face. Oh, that day. I cannot wait, Wheeler. We are going to light people up.
We'll see if anyone takes you up on that. Logan, thank you so much for walking us through what jobs week means, mortgage rates, what we might see there. It's always very entertaining, and I appreciate you. We'll talk again soon.
Pleasure.